Today we are going to read Menkyo's Principles of Economics. First, Chapter 1, 10 Principles of Economics. The word economy comes from the Greek word oikonomos, which means one who manages a household. So economy is manager. At first, the connection between households and economies may seem obscure, but in fact, they have much in common. Obscure, what obscure means? Obscure means not clear. So the author tells us, at first look, the connection between household and economics may not clear. No matter how you picture a modern household, its members face endless decisions. Somehow they must decide which members do which tasks and what each receives in return. What cook dinner? Who gets actual dessert? Who cleans the bathroom? Who gets to drive the car? Whether a household's income is high, low, or somewhere in between, its resources, time, dessert, time, mileage, must be allocated among alternative uses. So this paragraph tell us a modern household, its members face endless decisions. So it's like our human being. Every day we face many decisions. Somehow they must decide. So the decisions may be which task you do and what you get in return. Like a household, a society faces countless decisions. So a society also faces countless decisions. It must find some way to decide what jobs will be done and who will do them. Society needs people to grow food, make clothing, and design software. When society has allocated people as well land, buildings, and machines to various jobs, it must distribute the goods and services they produce. It must decide who will eat potatoes and who will eat caviar, who will live in a grand manor, and who will live in a fifth floor walk-up. So normally, economic means when a society faces many decisions, it must decide who will do what kind of job and who will get what kind of payment. These decisions are important because resources are scarce. Scarcity means that society has limited resources and therefore cannot produce all the goods and services people want, just as members of the household cannot always get their desires satisfied. Individuals in a society cannot always attain the standard of living to which they might aspire. So the main reason for economy is because resources are scarce. So the first important concept is scarcity. Scarcity means the limited nature of the society's resources. What means limited? Limited means we cannot produce all the goods that people want. We cannot make everybody satisfied, cannot get all their desires satisfied. So economics is the study of how society manages its scarce resources. Then we get to the main concept, economics. Economics is study of how society manages its scarce resources. In most societies, resources are allocated through the combined choices of millions of households and businesses. Economists examine how people make these choices, how much they work, what they buy, how much they save, how they invest their savings, and so on. Economists also study how people interact with each other. For instance, economics examine how buyers and sellers together determine the price at which a good is sold and the quantity that is sold. Finally, economics analyzes forces and trends that affect the overall economy, including the growth in average income, the fraction of the population that cannot find work, and the rate at which prices are rising. So economics are how people make decisions, and how people interaction, how people interact with each other, and finally analyze the forces and the trends that affect the overall economic. So economics covers a wide range of topics and encompasses many approaches, but it's unified by several central ideas. This chapter discusses 10 principles of economics. Don't worry if you don't understand them all at first and if you aren't completely convinced that they are sensible or important. These ideas will be explored more fully in later chapters. This introduction to 10 principles will give you a sense of what economics is all about. Consider this chapter a preview of coming attraction. So there's important concept or important feeling. So you must get the sense of what economics is all about. Get the feeling of economics. So feeling is very important. The first purpose, how people make decisions. There's no mystery about what an economic is, whether it encompasses Los Angeles, the United States, or the entire planet. An economy is just a group of people dealing with one another as they go about their lives, because the behavior of an economy reflects the behavior of the individuals within it. The first four principles concern individual decision making. So the first four principles concern only individual decisions. So only one people. Principle one, people face trades off. So normally trade off is a decision. There ain't no such thing as free lunch. Grammar aside, this old saying contains much truth. To get one thing you want, you usually have to give up another thing you want. Making decisions require trading off one goal for another. Consider Selena, a student who is deciding how to use his most valuable resource, time. Selena can spend all her time studying economics, all her time studying psychology, or divide her time between the two. For every hour she devotes to one subject, he gives up an hour she could have used studying the other. And for every hour spent studying, she gives up an hour that could have been spent napping, bike riding, playing video games, or working at a job of some actual spending money. So here I give you a feeling that everybody's most valuable resource is time. Time is the most important thing. Consider Selena's parents who are deciding how to use the family income. They can spend it on food, clothing, or Selena's tuition, or they can save some of their income for retirement or future family vacation. When they allocate $1 to one of these goods, they have one less dollar to spend on another. As a society, people face other trade-offs. One classical trade-off between guns and a button. The more a society spends on the military, the less it can spend on consumer goods. Another critical trade-off is between a clean environment and the level of income. Laws that require firms to reduce pollution may raise the cost of producing goods and services. But of these high costs, the firms are likely to earn smaller profits, pay low wages, charge higher prices, or do some combination of these three things. While pollution regulations yield a cleaner environment and the improved health that comes with it, they may reduce the incomes of the regulated firms' owners, workers, and customers. Another society trade-off is between efficiency and equality. Efficiency means that society is getting the greatest benefits from its scarcer resources. So we have an important concept. Efficiency is getting the most it can from its scarce resources. Society efficiency means that the society is getting the greatest benefits from its scarce resources. Equality means that those benefits are distributed uniformly among society's members. In other words, efficiency refers to the size of the economic pie, while equality refers to how evenly the pie is sliced. Efficiency refers to the size of the economic pie. Equality refers to how evenly the pie is sliced. These two goals can conflict. Conflict. Consider, for instance, the government policies aimed at reducing inequality. Some of these policies, such as welfare or unemployment insurance, help the members of society most in need. Others, such as the personal income tax, require the financially successful to contribute more than others to support the government. These policies increase equality but may decrease efficiency. When the government redistributes income from the rich to the poor, it reduces the reward for hard work for people at all income levels. As a result, people may work less and produce fewer goods and services. In other words, when the government cuts the economic pie into more equal slices, the pie sometimes shrinks. So when the government cuts the economic pie into more equal slices, the pie sometimes shrinks. It means when you increase the equality, sometimes it can decrease the efficiency. Recognizing that people face trade-off does not tell us what decisions are best. A student should not abandon the study of psychology just because doing so would free up time for studying economics. Society should not live with pollution just because environmental regulations might reduce our material standard of living. The government should not neglect the poor just because helping them would distort work incentives. Yet people will make better choices if they understand the options available to them. One study of economics therefore starts by acknowledging life's trade-off. So we begin the study of economics from acknowledging life's trade-off. So first thing first, we must know trade-off. When you make a decision, you must face trade-off. Trade-off. For example, two. The cost of something is what you gave up to get it. Because people face trade-offs, they need to compare the cost and benefits of alternative decisions. In many cases, however, the costs are not as obvious as they might first appear. Consider the decision to attend college. The main benefits are in intellectual enrichment and lifetime better job opportunities. But what are the costs? You might be tempted to add up the money spent on tuition, books, room, and board. Yet, this total does not truly represent what you gave up to spend a year in college. This calculation has two problems. First, it includes some things that are not really cost of going to college. Even if you quit school, you need a place to sleep and food to eat. Room and board are college costs only to the extent that they exceed the cost of living and eating at home or in your apartment. Second, this calculation ignores the largest cost of going to college, your time. So this calculation ignores the largest cost of going to your time. When you listen to lectures, read books, and writing papers, you cannot spend that time working and earning money. So this is the largest cost. When you go to college, when you read books, when you study, you sacrifice the time to work and get paid by money, earning money. For most students, the earning they forego to attend school are the largest cost of their education. The opportunity cost of an item is what you gave up to get it. When making decisions, it's smart to take opportunity costs into account. And people often do. College athletes who can earn millions dropping out of school and playing professional sports understand that the opportunity cost of attending college is high. Not surprisingly, they sometimes decide that the benefit of college education is not worth the cost. So there is another important concept, opportunity cost. Whatever must be given up to obtain some item. Opportunity cost it means if you want to get something, you must drop off something. You must lose something to get something. Principle 3. Rational people think at the margin. So we get to another important concept, rational people. What kind of rational people? It means people who systematically and purposely do the best they can to achieve their objectives. So rational people think systematically and purposely. Economics often assume that people are rational. Rational people systematically and purposefully do the best they can to achieve their goals, given the available opportunities. As you study economics, you will encounter firms that decide how many workers to hire and how much products to make and sell to maximize profits. You will meet people who decide how much to work and what goods and service to buy to achieve the highest possible level of satisfaction. To be sure, human behavior is complex and sometimes deviates from rationality. But the assumption that people do the best they can is economics have found a good starting point to explain the decisions that people make. The assumption that people do the best they can is a good starting point to explain the decisions that people make. People do the best they can is a good starting point to explain the decisions that people make. So rational decisions makers know that many issues in life are not black and white, but involve shadows, shades of gray. Many issues in life are not black and white, but involve shades of gray. At dinner time, you don't ask yourself, should I fast or eat like a pig? You are more likely to ask, should I take an extra spoonful of mashed potatoes when exams roll around? The decision is probably not between blowing them off and studying 24 hours a day, but whether to spend an extra hour reviewing your notes instead of hanging out with friends. Economics uses the term marginal change to describe an incremental adjustment to an existing plan of action. Marginal. Now we get another important concept. Marginal change is an incremental adjustment to a plan of action. It means not black and white, it's only some shades of gray. Keep in mind that margin means edge. So marginal changes are small adjustments around the edges of what you are doing. Rational people make decisions by comparing marginal benefits and marginal costs. Rational people make decisions by comparing marginal benefits and marginal costs. For example, suppose you are deciding whether to watch a movie tonight. You pay $30 a month for a streaming service that gives you unlimited access to its film library, and you typically watch 5 movies a month. What cost should you consider when deciding whether to stream another movie? The answer might seem to be 35 or $6. The average cost of a movie. More relevant for your decision, however, is the marginal cost. The actual money that you have to pay as you stream another film. Here, the marginal cost is zero because you pay $30 regardless how many films. In other words, at the margin, streaming a movie is free. The only cost of watching a movie tonight is the time it takes away from other activities, such as working at a job, reading this textbook. Thinking at the margin is also useful for business decisions. So you have formed the habit of thinking at the margin. Consider an airline deciding how much to charge passengers who fly standby. Suppose that flying a 200-seat plane across the United States costs the airlines $100,000. The average cost of each seat is $500. You might think that the airline should never sell a ticket for less than $500, but imagine that a plane is about to take off with 10 empty seats, and suddenly a standby passenger is at the gate and willing to pay $300 for a seat. The airline sell him the ticket? Yes, it should. If the plane has empty seats, the cost of adding extra passenger is tiny. The average cost of flying a passenger is $500, but the marginal cost is merely the cost of the can of soda Stanley will cost consumer and the small bit of jet fuel needed to carry his weight. As long as Stanley pays more than the marginal cost, selling him the ticket is profitable. A rational airline can benefit from thinking at the margin. So hold it in your mind, thinking at the margin. Marginal analysis explains some otherwise puzzling phenomenon. For example, why is water so cheap? Well, diamonds are so expensive. You might think it should be the other way around. Humans need water to survive, but diamonds merely glitter. Yet people are willing to pay much more for diamonds than for a cup of water. Economics have figured this out. A person's willingness to pay for a good is based on the marginal benefit that actual unit of the good would yield. The marginal benefit in return depends on how many units a person already had. Water is essential but plentiful, so the marginal benefit of actual cup is small. By contrast, no one needs diamonds to survive, but because they are so rare, the marginal benefit of actual gem is large. A rational decision makes make a rational decision maker takes an action if and only if the action's marginal benefit exceeds its marginal cost. So you must make your marginal benefits exceed your marginal cost. The principle explains why people use streaming services as much as they do where airlines sell tickets below average cost, and why people pay more for diamonds than for water. It can take a while to get used to the logic of marginal thinking, but the study of economics will give you ample opportunity to practice.